Welcome everyone to Vested Interest. This is Shane and this is our weekly portfolio update. We will cover the $1,764 we added in new capital as well as the reallocated funds, $10,553 and some change here from the Starbucks position that was called away last week, as well as the additional 11 shares that we sold off. This one, if you have been following the channel for a while, we bought several months back, and it has really run up with the announcement of a new CEO. And I feel like it's gotten a little, above its weight class, so to speak, as far as price per share. So I was willing to let this one go and reallocate the funds. But before we get into that, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who have subscribed to the channel. I really do appreciate it. The channel continues to grow because of people like you. And for those of you who may be stopping by for the first time, on this channel, we focus on dividend growth investing. It's not rocket science, in my opinion. The best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, buying dividend growth stocks in growing companies with positive cash flow that covers the dividends, and companies with a high return on their invested capital. I utilize both a dollar cost average approach, consistently investing into the positions in the portfolio on a weekly basis. I also do larger purchases whenever I have extra funds. If I do a side job, get a bonus, anything like that, I put into the overall portfolio. I cover all my investments on the portfolio. It is free to see what I'm doing. We all have enough to pay for. But if you would like to help me out, if you could go ahead and hit that thumbs up button down below, if you find any value in this content, make sure you are subscribed to the channel. Hit that subscribe button. Join us on this journey to financial freedom. Join the vested interest community. Click that notification bell so you're notified whenever we put out any new content. I do these portfolio updates every Sunday morning whenever any portfolio activity, again, whether it's options, whether it's the weekly investment that we plug in, dividends paid out, reallocations of funds if we sell a position or a position happens to get called away. Whenever we run those options, sometimes we do reallocate those funds into other positions. And so again, make sure you do all that. It really does help out a small YouTube channel like mine. And a special thank you to all the subscribers. Again, you guys are awesome. The channel continues to grow because of people like you. Now that we've got all of that out of the way, let's jump into the first activity of the week here, and we will start out with options. We need to walk through a little bit on this one. So we did run a covered call on SCHD, one contract here, and a lot of this is the funds from the Starbucks position that was called away last week. So that is where these funds came from. So one contract, that's what the -1 means, which represents 100 shares of SCHD. Expiration date was September 20th. That was this past Friday. The strike price was $83, right? This was a cash secured put, so we had the cash to buy these 100 shares at $83 per share. So for that to hit, it needed to be $83 or under. And since it closed the week over $83, right here you'll see it expired worthless. We kept the $30 per share minus the fees, $29.45. That's what this represents up here. So we did part of the funds that we reinvested or invested this week was this $29.45. Now the other two, excuse me, the other two we opened up last week. So right there's the SCHD, one contract, $83 strike price, September 20th. There it is, expired worthless on the 20th. The other two, CVS and AWK, CVS Healthcare System, that's CVS Healthcare, that's one we opened last week, as well as AWK, American Waterworks. We opened both of these last week. Both of them expired on the 20th. Worthless, out of the money. So we kept the fee, the options premium from those from last week. Now remember, we got those last week, so we invested that already. So we will probably continue to run the wheel on AWK and CVS. The only thing about AWK and SCHD for that matter is they don't let us do weekly options. They are once a month, I believe is how they roll these ones out. So we probably won't continue to do the SCHD one. We may look at maybe this 8,300. We just go ahead and buy the shares outright. AWK, but CVS CVS AWK, I mean, is the same as SCHD, once a month. CVS does let us do weekly covered calls, so we will probably continue to run this one here. Depending on what the premium is, we'll see what it looks like on Monday whenever we jump back in the market. So there's our options for the week. And here we're going to run through the reallocation of the funds. So again, we had the 100 shares of Starbucks that was assigned last week, right? So this was last week. That's why it was dated 9/13. But we reallocated the funds as part of the funds towards that SCHD covered call. So there's 8,300 of the funds there. Then we sold the other 11 shares that we held, so another $1,061.96. And we also received the dividend, but this does not get reinvested. So we received, as you can see here, cash in lieu of the shares. So instead of getting the 0.95419 shares we would have gotten if we would have held on to Starbucks, we received $92.12. So that's part of these reallocated funds as well. With the $1,061, well, with everything outside of the 8,300 we set aside to run the covered call on SCHD, we reallocated, the little over $1,000 here. I think it was more like closer to $2,000 here, 1,500, 275, 319, and like I said, the SCHD put. We reallocated those funds across Valet, ticker VALE. This is at the materials sector. 26 shares, picked up those shares at $10.61. 12 shares of Haverty Furniture Companies, ticker HVT, picked up those 12 shares at $26.64 per share, and 10 shares of Google, ticker GOOGL, out of the information technology sector, picked up those 10 shares at $159.09. And again, as you can see, we ran that cash secured put with the other $8,300. I think that it accounts for everything except for about $64, which most of that was the dividends paid out in Starbucks here. So we didn't really reallocate all of this. Some of that will go next week. I probably won't even cover it because it's such a small amount, but it will be part of the funds that we invest next week. Now, we lost shares, so we lost that income associated with the Starbucks shares, 111 plus this 0.954. So we lost those shares, but the offset here, picking up the 100 shares of SCHD, which we technically don't have yet because this was closed out of the money. So we didn't get assigned to those 100 shares. We still have the cash here. So that's what it's going towards. It's going to go towards SCHD. But we technically don't have those shares. And the new shares of Valet, HVT, and Google, we actually ended up on the positive side this time. Unlike the MPW, if you've been watching for a while, we sold some MPW shares here a while back when they cut the dividends for the second time. Unlike that one where we lost, we were in the negative. On this one, we actually picked up positive passive income in the tune of $79.53. So there's the reallocation of funds. Now over to dividends. We did receive dividends on September 16th from Next Era Energy, ticker NEE. This is a utility company out of the utility sector. Paid us $86.27. Now we do have the DRIP set. DRIP stands for Dividend Reinvestment Plan. So that means anytime a company pays dividends, in this case Next Era Energy, $86.27, it goes right back in and picks up more shares of that same company. So the 1.0146 new shares that it added an additional $2.09 in passive income over the next calendar year. And that is what when you hear people reference the dividend snowball effect, that is what they're talking about. I had already purchased shares of Next Era Energy. Those shares of Next Era Energy paid out dividends. Those dividends buy more shares. Those shares add more passive income. And that snowball continues to grow. Even if I don't add any new capital into Next Era Energy, every time they pay out dividends, this snowball will continue to grow, right? Now, if I add new capital, obviously it will accelerate that snowball as well. Now, finally, to new capital invested. On September 18th, we went in and put the bulk of our investment, $1,397.31, into the portfolio. With those funds, we picked up 2 shares of Cisco Corporation, ticker SYY, out of the consumer staples sector. Picked up those shares at $75.55 per share. 1 share of Procter & Gamble, ticker PG, out of the consumer staples sector as well, $175.25. 6 more shares to our Google position, ticker GOOGL, our alphabet position here. Picked up those 6 shares at $158.97 per share. And this one we're trying to build out, though it is back in the 160s, so we're probably going to nibble 2 shares, maybe 4 shares a week for a while. I'd like it to pull back a little bit, but I would like to build this out as well. And 2 more shares of CVS Health Corporation, ticker CVS, out of the healthcare sector at $58.56 per share. New income added, passive income over the next calendar year from the new shares we picked up in this $1,397.31 invested in the portfolio. $18.22 in passive income added to the portfolio over the next calendar year. And we weren't quite done. We went back in on September 19th, and this was actually the last day I did anything here. If you noticed, on Thursday, I did not do a stock pick of the day video. Apologize for those of you who tune in for those. It is my birthday today, September 21st, whenever I am recording this. And I did go up with some friends of mine and do some salmon fishing on Thursday night, all day Friday, got up early Saturday, came back home, and I spent the day with my family for my birthday. So that is the reason for no video on Thursday. There are not a lot of times where I miss a video out, but there will be times throughout the year where I might miss a day here or a day there because I just need a day off, and that was what I did. I took the day off and I did some fishing, but we did add a little bit more capital into our portfolio before we took the day off. And September 19th, we went in and added $366.78. And this is our weekly purchases, our two ETFs that we buy every week, regardless of what the market is. VTI, this is Vanguard Total Stock Market ETF, and that's what it is. It is the total stock market, the New York Stock Exchange here, one share at $281.96 per share. And SCHD, our Schwab Strategic Dividend Growth ETF here, ticker SCHD, we picked up one more share at $84.82, and these are both right at all-time highs, pretty close to all-time highs. Hard to add to them at all-time highs, but we're going to continue to add one share regardless of what the market is. We did not add the extra share here because we reallocated those 100 shares, like I've been saying for the last couple of weeks. As we get options premium, I'm going to look to roll that into SCHD. So we didn't do that this week, but we did get the 100 shares options that we ran there, and we'll roll with that 8,300 there. Either we'll roll another options play on that, or we will just buy the shares outright. We'll see what it looks like on Monday. I'd like to get them around $82.83 or $82 to $83 per share, but right now, again, $84, almost $85 per share. They just seem to keep me going up. I hope that they pull back a little bit this week. We'll see. Passive income from this purchase here, $6.49. Total invested, $1,764.09. Passive income added with the new purchases as well as the reallocation of funds, $106.33. Headed back in the right direction, almost to $12,000 a year in passive income. We'll see where it shakes out, but we're getting close. Now here, quick run through the sector weights. Communications makes up 10.78% of the portfolio. Consumer discretionary at 4.98%. With that sale of Starbucks there, when it was called away in the sale of the other 11 shares that we held, there obviously this position here has come down a little bit, 4.98%. It is not quite our smallest position, but it is down there now. Consumer staples, 9.38% of the portfolio. Energy makes up 5.94%. Financials at 4.86%. Healthcare makes up 13.92%. Industrials at 6.66%. Technology makes up 8.35%. And as we add to Google, this one's going to get larger here. Materials makes up 8.64%. Utilities makes up 9.62%. REITs and real estate at 9.19%. And ETFs here is starting to get to be one of the larger positions in the portfolio. Still not quite the largest, though. 7.68% of the portfolio. Over here on the right, you can see the sector weights broken down. Here's the percentages that match the pie here, as well as the dollar amount allocated to each sector as well. Now here it is. I show this every week. I want those of you out there who watch the channel to see a real portfolio built out over time so you can see the ups and downs of the market as well as ups and downs of individual positions. It is normal to have big swings in stocks. It happens all the time. Stocks have a 52-week high and they have a 52-week low, and they could touch that 52-week low, even set a new 52-week low or set a new 52-week high and bounce between the two of them several times throughout the year. So that is why I have this 15% of a 52-week low. I like to try to buy my positions whenever they are within that 15% of a 52-week low, or match my buy-in price to where it matches within 15% of a 52-week low for a buy-in entry. But I want those of you, again, who are out there building a new portfolio or maybe on the fence, haven't started yet, to see a real portfolio so that you can understand the ups and downs of the market. And hopefully it gives some of you the encouragement to stick with it. Don't sell whenever you see red. If you've done the research and you've bought good companies, whenever you see red, those should be buying opportunities, right? That is my opinion anyway. And Warren Buffett famously said, if you can't handle a stock dropping by 50%, you should not be in the stock market, right? Just stick to ETFs, maybe VTI, VOO, which tracks the S&P 500. He would recommend something that tracks the S&P 500 for most people, so an index fund or ETF that tracks the S&P 500. If you just want something that you can dump money into and not have to do any research, not worry about the ups and downs, that's what you should look at. For those of you who are looking at individual stocks, right, those down times, again, if the stock is a good company, the fundamentals haven't changed, their revenue is still growing, their margins are expanding, their business is not taking a hit, then you should be buying more of the company. But I'll get off that soapbox here. As you can see, the ticker, all the positions in the portfolio here, total shares I own of each company, current price as of the close of business on Friday, market value as of the close of business on Friday, my average cost per share, what I have into the position overall. This does include reinvested dividends, total return, whether I'm up or down. Again, I want you to see it because it does happen. There are swings in the portfolio overall as well as in individual positions. 52-week highs and 52-week lows exist for a reason. Percent return, whether I'm up or down here, you can see the percentage. And obviously the red means I am down. The more green it is, the more I am up. Sector each position falls in, whether it's a quarterly, monthly, semi-annual payer, and how much they pay here. You can see the highlighted in yellow. Those are the companies that have raised their dividends already for the year. Obviously, you can see some are not highlighted. Those are Google. I missed they haven't done a raise yet. They haven't been paying long enough to do a raise, so we'll see what their raise is. I am hoping for a double-digit raise from Google. That's what I'm looking for. The others are just companies that have stopped raising their dividend. Ally stopped a couple years ago. I want them to start again, but they're just not. Google, we talked about. KHC, same thing. Whenever I bought this, I knew that they weren't raising their dividends. I was hopeful that they would start back up again. They have not yet. OHI, same thing. Not as concerned with this one because it's such a high dividend yield on this one. I locked in a 9.328% yield on cost. Obviously, if you were buying it now, it's much lower than that at 6.63%. AT&T, same thing. When I bought this, they had canceled the dividend, so I knew that going in. So I'm not expecting this one for another year or two to start. But I would like them to start back up. Current yield as of the close of business, my yield on cost, portfolio weighting. So as you saw on the previous slide, each sector's weighting. This is each individual position's weight. I also have a rule in the portfolio. I don't want any one position to be more than about 10% of the portfolio, and I don't want any sector to be more than 20 to 25% of the portfolio. Now, that doesn't necessarily account for ETFs or index funds. Those I don't mind being a larger position, but I'm talking about individual positions. Estimated annual income in this column, payout months, what months they pay out, dividend growth year over year here, and where it sits at 15% of a 52-week low. So I use this as a benchmark of where I want my average share price to be. So let's use this as Ally for an example. It's currently above my buy-in price, right? $25.81 is my cost per share. 15% of a 52-week low is $25.92. So at $34.48, I'm really not interested in buying it. I might be able to add a couple shares and still be under my cost basis, but not a whole lot. Same thing with Kraft Heinz. Right now, it's under my cost basis, $35.24, and it's under where it sits at 15% of a 52-week low. So at $34.94, 15% of a 52-week low is $35.24. This is one I could add to. It's both under my cost basis. It's also under where it sits at 15% of a 52-week low, right? Same thing with CVS. My cost basis is $66.16. 15% of a 52-week low is $60.68. So I should be trying to bring down my average cost per share in line with this $60.68 while it's under my cost basis and while it's under 15% of a 52-week low. All right, so hopefully that made sense. Quick run through here. Total shares, 5,779.011 shares. Market value, $302,820.14. So this does continue to go up. Last week we crossed over 300,000 for the first time, so that was a nice milestone. Purchase price, what I have into the position, $270,984.94 in the overall portfolio. Again, this does include reinvested dividends. Total return, $31,835.21, up 11.75%. This is not what I'm focused on. Nice to see. I do like to see my portfolio climbing in in value, right? Don't get me wrong. I do like to see that I'm up 11.75%, that my money is making money for me. Current yield 3.919%. My yield on cost 4.38%. This is what it's about. This is why it's circled in red here. The average income, the dividends paid out by all the positions in the portfolio continues to grow up week over week, month over month, quarter over quarter, year over year as I add new capital, as the positions in the portfolio pay out dividends, as those same positions raise their dividends, and as those dividends get reinvested. Currently sits at $11,868.97. I feel like this is about where we were about a month ago before MPW cut that dividend again. So I think we're right back to where we were here about a month ago, getting very close to $12,000 a year or $1,000 a month in dividends. I think we'll get there over the next 2 to 3 weeks here. Sometime in October, we will pass that threshold, and that is our next benchmark. And then it's on to 15,000, or I'm sorry, we'll look at 20,000 beyond that. Maybe we'll look at both. We'll look at 15,000 and then we'll look at 20,000. So from 12,000 we'll look at 15, and then from 15 we'll look at 20, and then start looking at it in $5,000 increments, and then maybe $10,000 increments after that. Dividend growth is 5.95%. Again, some of these that are zeroed out, Baba, I'm hoping that they raise their dividend. They just started raising their dividend, or just started paying dividends last year, so we'll see what their raise look like. I'd love to be that be a 10% dividend raise. Google, same thing, recently started paying a dividend. I'd love that to end up being a double-digit raise and beef up this dividend growth a little bit in the overall portfolio, but we'll have to wait to see what that is. Hey, let me know what's going on in your portfolio in the comment section down below. What are you buying? What are you selling? Are you running options? If so, what options or what companies are you running options on? Would love to hear from you. And that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey into financial freedom. Join the vested interest community. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So again, let me know what's going on in your portfolio. What are you buying? What are you selling? Are you running any options? Are you watching some stocks, looking for more of a pullback? What's on your watch list? Would love to hear from you. I do the stock pick of the day video series Monday through Thursday. So again, if you have a company you'd like me to cover in that series, go ahead and drop it in the comment section. I'll work into the rotation. Make sure you click that notification bell so that you are notified whenever we put out those future videos. And this is Shane signing off. Wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk and handles money. Should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.